Okay. All right. So the next question we got is, what is the difference between a traditional and an SDI IRA?
So the traditional, the biggest difference is the traditional. You have people taking care of your money, and with the self-directed, you get to direct your money. But you do have a custodian that you place your monies with, but they don't tell you what to invest in and what not to invest in. Some of them will help you with guidance on the rules and making sure that arm transactions and stuff like that, and no prohibited transactions are happening. So a prohibited transaction is like I can't go and do business with my parents or my kids with my IRA as well as myself. So now I can invest with those people as far as what they invest in and whatnot, but I can't invest into their business or their deal and vice versa with their family. The big bonus here too is by you having control over your investments, you can set it up to make more money with your money than normal routes. And that's the best thing because most people don't realize that on stocks and whatnot, they're after fees and everything, they're usually getting around 6% interest on their money. And with the ups and downs of the stock market, obviously that covers that too. But like if you were to be a lender with your self-directed Roth or your self-directed IRA, then you have a set amount. So let's say you've got your IRA set up and you got 150,000 in it, and I find this house and I, I come to you as a private lender, and you lend to me from your self-directed account, and we decide that 11% interest is a good interest rate for the property and for you, then the life of the loan, your money is earning 11% interest, which is obviously better than the norms, and it's solid. It's you got a one solid rate for the entire length of the term or term of the loan, and then on top of it, it's backed and secured by real estate and real assets. So now you can also do unsecured loans with that and stuff. And obviously, with the risk of unsecured loans, you would want a better interest rate, but there's also higher risk for that as well. So it's you definitely want to do your due diligence on anything you're loaning on, but as far as growing your money, there's not a better way to grow your money than self-directed accounts. And nobody cares about growing your money more than you care about it. So the broker that you normally get through regular accounts, um, they get paid every time they move your money. So who cares about actually growing your money more, them or you? Well, it's more about moving the money for them so they make more money. Everybody's got their own interest. I mean, at the end of the day, even if they care about you and care about your money, if it comes to food on their table or growing your money, it's not rocket science. Who they going to choose? You know. So Bill, I see your mouth moving, but we lost.
Sorry. It was.
Sound.
I think I was getting mic feedback there. I had it on mute. Sorry.
Oh,
I think
cool.
that covered the number three there, which is why you would want. What's the difference between SDRA and traditional? You pretty much covered that answer, I think. And then the next one is we had what can I put in my SDIRA? Like certain things you can put in there, or pretty much anything.
There are some limits, but it's more open to what you can put in. Like you can actually invest in gold and stuff with that. With your IRA, you can invest in real estate. Again, lending. Businesses, you can own businesses, you can own stocks in businesses or ownership in businesses in your IRA. Again, you've got to keep everything at arm's length, so you're not owning an LLC that you're running. Um, and whatnot. Now there are ways through a Roth, which is a very sophisticated type of account, and you got to know how to set that up and have professionals in the mix there. But with a Roth, you can actually work for the company that is in your self-directed account. Did you mute again, Bill?
Mute again, Bill. All right. What kind of self-directed accounts are available? We had several different kinds of, I believe, right?
Yeah, so there are a few different kinds. Your most popular ones will be your Roth and your self-directed IRA. Um, if you're self-employed, you can go a solo, a 401k, which the beautiful thing about the solo 401k is your limits are way higher. So a Roth, you're only limited to you're limited to, unless you're above 50, you're limited to $7,000 a year in a Roth. If you're above 50, it's $8,000 a year. And then a solo, I believe it's around the 70 or 77,000 a year that you're allowed to put in to that. So even at the 70, it's a much higher number that you're able to stick in your retirement account, even larger than the 24,000 that traditional IRA or your self-directed IRA is allowed. So the solo, if you're, and again, you've got to be running your own business to have a solo. But then you've also got the CESA, which is an educational savings account for your kids and grandkids, and then HSA. The HSA is actually a beautiful one because it gives you tax advantages in every way possible. So the money you put in is got deferred tax, so you don't pay taxes on that money. You grow your HSA, and that money is not taxed. Now, unfortunately, you can only pull it out for health stuff dealing with health, medicine, stuff and like that. And that's the only way you use it. And then, of course, it's not taxed there either. So you got three benefits on taxes with the HSA. The flip side is, though, is you don't have to pull those dollars out as you use them. So you save your receipts, and you can compound them receipts for years and years. So let's say I had to buy medicines this year, prescription medicines and whatnot this year. If I saved them receipts, and let's say I've grown my HSA huge to in 10 years, right? Then if I kept them receipts the 10 years and just stockpile them, 10 years down the road, I can take all that money out, and now it's still tax-free money. So bonus of doing it like that, you leave more money in your HSA now to grow it to where you can grow it to large numbers. So when you pull it out, you have a tax-free dollar amount that could be a potentially huge dollar amount, depending on your situation.
Right. The more you leave in there, the more faster it can grow because you're compounding on larger numbers.
Exactly. So there's the HSA is like the it's not the best one because you can only use it on medical, but it is the one that has the most tax advantageous means of it. So, which all of them have in their own right, because like even the CESA with your kids' savings account, depending on what your kid needs as they go through school and whatnot. Let's say that you're real limited on the dollar amounts put in. So you can only put in like 2,000 a year. But growing through the right channels, obviously you can grow even small number, dollar amounts to larger amounts. And then let's say you started that when your kid's, born or 1 or 2 years old. When they get to 16 or so and they actually have more expenses going to high school, that'll help cover that. Not going to tell you that it's to do it or not to do it. You check with lawyers and whatnot, but I have heard of people, their kid needs a trip during spring break, and that trip is paid for, by their SESA. I've also heard of, the 16-year-old needs a way back and forth to school, and a SESA buys them a car. So, not saying it's the thing to do or not to do. I've just heard of people doing it, and at this point, I have not heard of anybody getting audited for that. So, the thing is to always play in the green, yes, but there's different shades of gray in the areas when you utilize your self-directed accounts. And I would say that those shades of gray, the risk versus reward, is where you decide whether, okay, that risk is worth taking versus the reward, and wait, that risk is too high. I'll give you an example. A friend was starting going to start a SESA for his child. The child was the wife was still pregnant with the child, so he goes and talks to lawyer, and lawyer says, well, technically, it's never been put through a court system, so you might get away with it. But for a couple months of waiting, was the risk versus the reward worth it? So he decided that the risk and reward wasn't worth taking the risk, because obviously if the IRS comes back and he loses in a court battle with them, then now all that money that he's grown in there is taxed money. So you weigh out that risk versus reward when you're playing in the gray and the different shades of gray. And then the black you never do. The black are the prohibited transactions, but that's places you just never want to play. It's not worth it. Those are the transactions, like I said, like if you're dealing with immediate family in a business deal and whatnot, you don't want to use your self-directed accounts because that's a prohibited transaction. And now that everything you grow from that point and everything you take out from that point and everything has potential to be taxed, and then penalties on top of that tax. So it's just not worth it to play in the black. And like I said, the different shades of gray you play depending on the risk versus reward.
That's a lot of good information, and obviously we need to make sure that everybody's checking with their lawyer and their CPA and whatever. This is only entertainment advice. We're not really giving advice. We're just giving entertainment to let general information.
Absolutely, yeah. Always consult with your lawyers and attorneys and CPAs and all that. And then also know that as you grow your wealth, according to my mentors that have upgraded their CPAs and everything multiple times, at some point you will outgrow your accountants and stuff like that. So always, if they're not giving you the right answer, not necessarily the answer you want, but the right answer, then it might be time to get a new one. So I wouldn't necessarily, if you've got a hard question, talk to multiple, even if you've got one that you've got doing your stuff, because if one knows more than the one you've got dealing with it, maybe it may be time to upgrade your CPA.
Not that they would give you bad information on purpose, but they're not everybody knows everything. There's too many laws to keep up with. So
absolutely,
in their particular niche, they might be the expert, but when you grow out of that niche, you might be not quite as knowledgeable as somebody next to the next level up. So
absolutely,
it's like going to a lawyer that's deals with real estate as opposed to going to somebody who's a probate lawyer or something. They're not going to be in the same. There's too many things to know. Each one has their specialties. Awesome. So I think that was all the questions we had there, Jody.
Sweet. Is there
Anything else you want to add?
any of those that you would add anything to, Bill? That I know there was one you posted about the other day, and of course I had been leaning towards always loan money with your Roth and stuff, because you don't get any tax benefits now. But your post the other day had pointed out that it's depending on your goal, it might be advantageous to actually own real estate in your Roth or your 401k. Can you give me some info on that?
Generational wealth. So if you want to buy property in your Roth, you want to put it in your. By putting it in your Roth, you are allowing your property to build up and be able to pass it to your generation, to your children or your grandchildren or whoever. You can do that, and they can keep it without taxes. And any income they're making off of that, anything you're making off of that, when you put the money in the Roth, you're going to pay taxes on it. But once you invest it, it grows exponentially, then it's all tax free, and your kids get it tax free also. So you want to be able to pass that down without having to pay them, and they don't have to have estate taxes, income taxes, or capital gain taxes. All those things that come into play if you just bought a house straight off the street with a regular mortgage. This way, you're protecting them in the future, and they could be getting, if it's making income and everybody's happy with it, then they can be making for who knows how long. So it's just a way to pass it down without having to give Uncle Sam a piece. So.
Nice. So the way I took that is I should keep my plan on track like it is for right now, while I'm focused on my retirement and my means of retirement. But after I've built to the point that my retirement's solid, and now I'm looking for future generations' retirements and whatnot, that's when I actually put inside my Roth, and then they get to inherit that for tax free. And if I'm not mistaken, they can run it out of my Roth for 10 years after my death, all tax free. And then at that point, they got to cash it out, right? And all that, even cashing it out, is tax free.
I believe so. Yeah, I believe that they have to put it over there in their own personal Roth, but which means after a certain point, they may not be able to draw interest on it. I'm not sure with that, but at some point, they will be required to take some of it out. But I mean, like you were saying, you stay on your plan for now. But as you get more, say if you're pushing 55 or so, you start hitting your mid 50s, you might want to start planning in that direction, because once you hit 59 and a half, and if you're making $3,000 a month coming into this, now you're pulling $3,000 a month tax free. If you're making, say you're making $3,000 a month on this co-living property, and it's bringing in this money. If you put it outside the Roth, you're paying taxes on it at 20 or 30%, whatever your tax bracket is. Or if you buy it inside your Roth, once you hit 59 and a half, that's just gravy train. You don't have to pay Uncle Sam.
Oh, sweet. I like that. I like the idea of starting that even in that avenue at like the 55 range, like you say, because it gives you the 4.5 years to grow that. And then, if you've got solid cash flow coming out, that's actually there's a scenario. So basically, if I can use letters in algebra because it's good at algebra, but basically if A equals B and B equals C, then by default A equals C, right? So basically if something equals something, something else equals that too. Anyway, that being said, that's more difficult to understand that way, but basically what I'm getting at is $1 million sitting in the bank will net you about $5,000 a month income. So basically, if you set it up to where your Roth owned enough houses that at 59 and a half, you're getting $5,000 a month, whether it be $1 million worth of property or 300,000 or even 100,000, doesn't matter. As long as it's bringing in the 5,000 a month, that's the equivalent of having $1 million in there.
Something else I just thought about that another way to look at that is you might not even want to wait till you're 55. You were saying, say you're 50, or sorry, you know, it's in your future. Hell,
Yeah.
even if you're 30, if you put it all in your Roth today, and say I'm 30 years old, I'm pulling that, I put that money in there and say, okay, I'm making $3,000 a month off this property. How long the catch would be if you sell it? You might have to pay more, but I'm saying if you're taking money out of your Roth, you're going to have to pay a well, there's a 10% penalty. I think might cost you an extra. I forgot about the penalty, but you would still have to pay the taxes on it. As money you take out, you would still pay taxes on it.
Yeah.
What I was saying is, I was thinking is, pull the money out, you're still going to pay taxes on it anyway, like you would pay taxes on it if you had it outside the Roth. It's just going to cost you an extra 10%. Problem. So maybe not such a.
Yeah, it's a great tool for after you're 59 and a half, but let's grow it as much as we can till 59 and a half, right?
Yeah, but I mean, if you needed to pull, if you was going to pull all of the 3,000 out and you needed to live on, then that'd be a good plan. But if you had $3,000 and you only needed 1,500 of it, the parts you didn't pull out, you're not paying taxes on. Depends on how you need the money personally, or where you want to do with that money.
Yeah.
Even if you sell it, actually by putting it in your Roth first, and you kept it there 5 years, and then you need to sell the place. Okay, now it's gone up in value. Now there's no capital gains tax. You have this and this. You can't pull the cash today without paying a penalty on it because you're not 59 and a half. But that would roll over the profit. All the profit off that house would roll back into your IRA as opposed to being in your pocket in Uncle Sam. So that's another way to look at it there too. If it depends on where you are in your finances. You need that money to buy something else. Well, you could still buy it inside your Roth. But if you're going to cash out and just put the money in your pocket, then it's prudent because you have to pay 10% on it out. But if you're just going to roll it over into the next account, take it out of this house, I'm going to buy this house, I'm going to sell this house. It made another $100,000 in profit. Now that money is now extra in your IRA. You take your IRA and buy another house with it. You just built on the block. The block just got bigger, so you're playing with a bigger block of cash. So kind of works. I would think it just depends how you want to look at your money, but you need to actually live on. You got to pay an extra 10 to get out of your IRA. But other than that, growing cash tax free, a whole lot better than growing and paying the capital gains on it, which might be more than 10%. Income.
Yep.
All
right, sweet.
That's a pretty good thing. My YouTube crashed partway through. YouTube says it's recording, so I don't know what happened to that. I don't know as far as your live thing goes on the Zoom. I'm not sure if it goes live to. Doesn't go live to anywhere because it didn't record it. So it didn't go to your Instagram or anything. It didn't go to your YouTube.
The bad thing is I didn't have that recording.
Recording in progress.
Yeah, see. I recorded it, but I started a couple minutes late, and even then I got 23 and a half minutes.
Recording stopped.
I started a little bit late on it, so but it says it started streaming. But YouTube, I got an error on my YouTube. I'll have to go. Got to go to YouTube.
Yeah, mine
was weird. I got to go to YouTube and stop it, and then I got to stop it on OBS. So both of them I have to stop both streaming things.